Hello, everyone. Welcome to today's Practitioners Insights webinar on evaluating high-performance offshore investment opportunities. What are the risks? Hosted by CFA Institute. First and foremost, a very warm welcome to our audience from around the world who have joined us today for a very engaging and interesting discussion on a topic which is familiar to many, but not maybe for several others. I am Pankaj Sharma from CFA Institute India, and I will be the moderator for this session. I lead capital market policy for CFA Institute India team, and I look at a range of issues which are relevant for stakeholders in the capital market ecosystem, including sustainability, asset investment options, and several others. First and foremost, before I introduce our speakers for today, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A. Should be around 40-45 minutes for the presentation by our speakers, and then 15-20 minutes for the Q&A. There will be enough time for questions and answers, so please do send across your questions during the session, as well as once the presentation is over, and we'll try to take as many as possible to include in this webinar. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. We immensely value your feedback, so please complete the evaluation survey before you sign off today. Now it's my pleasure to introduce our speakers, Mr. Nicholas Levitt and Mr. Indranil Roy Chowdhury. Nick is the founder and CEO of Entrepreneurs Investment Office and Demeter Investment Holding. He has 25 years of global experience in international banking with HSBC. He has worked in senior positions, including EXCOs and boards in several geographies, including Hong Kong, UAE, Qatar, India, Indonesia, the United Kingdom, and Mauritius. His broad exposure took him across multiple disciplines of corporate, investment, risk, and private banking. The Entrepreneurs Office EIO was established in 2016, and he joined the group in 2017 as its CEO and founder. EIO is owned by several entrepreneurs and high net worth individuals, and is currently focused on being the investment advisor to a number of real estate funds with assets under management of nearly $2 billion. Nick was born in Lusaka, Zambia, and is a citizen of the United Kingdom. So because of his work experience and the different geographies he has seen, he is a global citizen in its true sense. He went to Emmanuel College, Cambridge University, and Exeter School. His passions are work, family, and friends, and exercise. In particular, when these activities involve spending time with great people, solving highly complex and interesting problems, and growing businesses. Welcome, Nick, and thank you for joining us today.
Thank you.
Indranil Roy Chowdhury, Head of Group Strategy and Investment, Demeter Investment, is a senior advisor looking after growth and in development for Demeter Investment Holdings. He is a seasoned professional with more than 20 years of experience across the entire spectrum of investments, mergers and acquisition, fundraising, corporate strategy, and risk management. He had a long tenure working at a high-performance environments of government-owned investment vehicles, GRE of Dubai Holding, and MR across both listed and privately owned entities in the UAE. He has also spent substantial time working with a major UAE-based family conglomerate, looking after investments and strategy. He is well exposed to the tech sector through his role at Nokia mobile phones and subsequent stints at the Founder Institute and Techstar. Indranil has a wide industry investment and asset management experience across several sectors, including real estate development, hospitality, retail, logistics and marine, automotive and electric vehicles, energy, both conventional and renewable. SOCOM sectors include education and healthcare, and several others like agriculture and food production, mining and minerals, business to business equipment, and machinery trading, banking, and insurance. and heavy industrials. He has initiated and closed several multi-billion-dollar opportunities in these sectors. Indranil is a summa cum laude from the prestigious Xavier School of Management, India, with a postgraduate diploma in management specializing in strategy and finance, and a magna cum laude from the prestigious Visvesvaraya Technological University, Bangalore, India, with a Bachelor of Engineering degree in Electronics and Communication. He is also a standing member of CFA Institute and the Brookings Institute. Welcome, Nicholas. Welcome, Indranil. And it's a pleasure to have you here with us for this discussion today. I'm sure that our audience is eagerly looking forward and will have a great experience listening to you. So without further ado, over to you.
Pankaj, thank you so much for the real glorified introduction for Nicholas and myself. The topic today, evaluating high performance offshore investment opportunities and what are the risks. This is going to be quite relevant to the audience who have come in. So first of all, good morning, good afternoon, and good evening to everyone who is listening in, wherever you are, as well as to those who will be listening to the recorded version. Thank you again so much. So I'll start off with a little bit of background of what we do at EIO, the Entrepreneurs Investment Office. Now, we have a series of different high-performance strategies, and then we also have a series of joint ventures. For us, high-performance strategies are anything which we incubate and commercialize, giving a target 4% return on the dollar per month. And that should set the scene of what the discussion we are going to have forward. First of all, as we move on to the next slide, the scope of the issue in the emerging markets, as I've noticed over a period of time, are the last to receive high-quality investment opportunities. That is probably from the aspect where the purchasing power is also an issue. And these are things which I'm going to discuss in the subsequent slides. And as it also happens, the emerging market investors are also targeted for scams when these are launched and introduced and distributed to them. And what happens as a result, at the end of when somebody invests in such a product, they end up saying, oh man, we have lost money. They get totally scammed out of it. We'll move to the next slide. So some of the learning outcomes which we are looking to address for people who are listening in and for the bigger audiences, how should the investors look at the strategies and the assets? Some of them are low performance investments pretending to be offering high performance returns in overseas investments. What should be the ideal framework to avoid the major risks? What kind of due diligence and what do the investors need to see to protect their capital? We should also address what are the typical characteristics of the scams and some of the most common investment pitfalls and how to identify the same and address these challenges. And ultimately, we are also looking at how to have a monitoring of this whole investment scams. How do we ensure that investors and their managers successfully oversee third parties so as to ensure the quality of the service providers? Can you move on to the next slide? In the upcoming slides, we will be discussing what are the real issues, and we have put it across 5 very precise points, how low performance investments are dressed up as higher returns, how are the scams, what are they, how to avoid those major risks, what kind of due diligence should we do before we get into these kind of investments, both from individual perspective as well as from a corporate perspective. And very importantly, what conditions, how can I protect my capital? And very important as a framework, how should we monitor them? These are 5 very topical subjects which we have selected for today's, what is going to be a very interesting discussion. At this point, I'll hand it over to Nicholas, the founder and the CEO, who will take us through the rest of these slides. Thank you.
Thanks, Indranil. Thanks, Pankaj, and thanks for moving on to the next slide. So the basis of this discussion from here until we get to the end of the formal presentation based on our experience of a high percentage of strategies, investment opportunities that we get to see through our office. And over the years, we've developed a degree of expertise in identifying some of the tricks and trends that people undertake in order to either over-represent or misrepresent the situation and the real underlying performance. And that basically falls into two buckets: overstatement of performance, and then secondly, what is just outright misrepresentation of performance, either through scam or some other sort of mechanism. So in terms of the first subject that we're talking to, it's about evaluating the performance of the assets. And quite often, the industry standard is for you as a potential investor to be presented with a two-page summary sheet on how a particular investment opportunity is being done. And there are multiple ways that investment performance can be tweaked, changed, and altered in order to enhance the performance. I think basically the three most common techniques that we see are basically: one, playing with the IRRs and cost of capital. Secondly, how to allocate costs and fees. And thirdly, what base is used to calculate those results. So if you take, for example, at the moment, the US private equity and venture capital fund, it's been quite widely reported in the press that there's been a lot of round robbery between assets being transferred from one private equity or venture capital fund to the next. And basically, as that transfer been taking place, it's our argument that a lot of that is done at a mildly inflated exit price from one fund to the next. That's probably arguably not substantiated, but is increasing the book value of that asset as it gets transferred. And a recent study undertaken in this area actually demonstrated that for a private equity investment in the United States to be genuinely exited rather than passed on to another private equity fund was taking on average 14 years, which is nearly twice as long as the average American marriage lasts for. That's quite a stunning point. The exit point being more of an IPO, a trade sale to a strategic buyer, or some other exit as opposed to going into the fund. In those calculations, the most commonly manipulated figure is...
Sorry to interrupt you, there is some of the feedback which is coming from some of the audience that you are not very clearly audible. Of course, I can hear you, but if you speak a little louder, I think that will be very helpful for everyone. This is a feedback.
Sure. I'll also speak closer to the microphone, Pankaj. Thanks for that comment.
Thank you. Thank you, Neil. Thank you.
So manipulation of cost of capital, IRR returns, is one that has to look closely. I don't think we have to go into detail how to do that to an audience of CFAs. Everybody should be very well qualified in that field. The second area is fees that are basically included in the cost base, so that they are actually artificially taken out of the cost base and presented as an operating cost into the business. And then the other one, which is again a very common one, is manipulating the base where the percentage growth is actually calculated off. And that can be either on the original capital vested, how the valuation is done, and there are multiple ones. But typically the advice is to look at the denominator rather than the numerator, because that's the one that's most commonly manipulated. If we could move on to the next topic that we wanted to cover, and this was really is very prevalent in international markets, and this relates to the area of scams and the number of scams in circulation. Probably the largest in volume is a combination of totally fictitious standby letters of credit, bank guarantees, or MTM instruments issued by global banks, institutions that are fraudulent. I would suggest that if you start to see instruments of this nature that are above about $100 million, the probability that these are actually fraudulent is more than 99%. Okay, banks don't issue instruments of this size on very frequent occasions, and you'll start to look through going through some of the details on these instruments that basically they're entirely fictitious and related to some form of liquidity or financing opportunity that just simply doesn't exist. Key things to look for that we see, a number of these instruments are signed off by chief executives or chief operating officers at the global banks. These people don't sign off any financial instruments anymore because of the liability attached. And so basically, if you see a chief executive or a chief officer of Barclays or HSBC signing these documents, I would be very, very wary. So look for the amount, look for the people who're signing these off. And then the other big initial sign that is a big warning sign is the use of companies' stamps and chops well beyond the use that would normally be encountered in electronic instruments in this day and age. So those are the three warning signs. The second area that we get approached a lot is people approaching us that are allegedly part of a large global bank or institution that is empowered to move large amounts of money, but is not advertised as part of that bank or institution. It's a secret closet, or it's a secret department. All of this is absolute nonsense, of course. And these are basically the fraudsters trying to develop a relationship with you in order to, predominantly the way that they work is to try and get some form of fee initial payment out of you, allegedly to start the transaction off. But in fact, they're just arranging the scam in order to get that payment out. But I can assure you, sitting on the global executive of one of the largest divisions of one of the largest banks in the world, none of these divisions actually exist. The third area I'd like to turn to is scams relating to asset-backed lending and asset-backed deals. These typically involve a lot of natural resources, such as gold and oil. One that we were recently presented with, which was very interesting, was a gold mine that was located in Nevada in the United States. This particular lending, which was allegedly for $2 billion, was backed by proven gold reserves. And when we looked at it a little bit closer, we noticed that the person certifying the deposits was the same guy who was the chief operating officer of the organization. So clearly a massive conflict of interest. And basically, it turned out, as we suspected, to be a fraud. I think many of you are familiar with the Ponzi schemes. They tend to be increasingly prevalent. The areas that I would particularly start to look at is when very aggressive return rates have been produced above 100%. There is a fair amount of these schemes that we've been encountered in the digital assets and cryptocurrency space, along with other asset classes that have the ability to produce high performance as well. But when the Ponzi schemes get unveiled, they get unveiled very badly, such as the cases of Madoff, etc., and so on and so forth. And then the final area that I just wanted to talk to around these scams is people who approach you with money transmission methods that appear to be outside of the usual or the normal that a bank or a financial institution will take. So you will see people approaching you with concepts like pings, which apparently is a method that you can check your balance at the respective bank by pinging the account. There is no such thing, okay? It is made up by fraudsters to try and get money out of you. We've also seen a lot of transactions involving what are described as off-ledger transactions. Given your background, it will not amaze you to understand that basically banks are not allowed to have off-ledger books. They just simply do not exist. And they certainly can't exist with billions of dollars as the fraudsters would make out. So that's a little bit about some of the scams, some of the overperformance that we've seen in our history. It really is down then to how do you start to think about protecting yourself should you go through these and ascertain that there is perhaps a legitimate opportunity to invest here? And where we basically recommend people to spend a lot of time is around the due diligence. Okay. Now, 99% of the investors that we interact with spend the vast majority of their due diligence actually trying to unpack and delve into the investment strategy itself. This part of the process is important and does warrant some time to be spent on. However, it is rarely the reason of why a strategy will get into trouble. Okay? Most importantly, these strategies will get into trouble due to two factors. One is the infrastructure around the strategy, and the second is actually an incident which is outside of the strategy that comes in to affect the strategy. Okay? It's very difficult to forecast the latter. Understand what you don't know is what you don't know, and trying to anticipate what you don't know is a very difficult skill to master, believe me. But what you can spend a lot of time, and I would recommend you spend a lot of time, is due diligencing the infrastructure behind any strategy or investment. And what sort of things do we mean around that? Ourselves, for example, we're very exposed to currency markets and foreign exchange strategies. We spend a lot of time looking at the technology that's deployed in these strategies, the quality of the exchange. Are they regulated? Where are they incorporated? What is their performance, financial performance like? What is the quality and caliber of their management team in order to ascertain whether there's substance behind this opportunity? And I would really strongly urge you to spend a lot of time in this area. It doesn't matter whether it's currencies, whether it's equities, or whether it's any other type of asset. It's very important to go down through the drains of strategy to dig really deep to see if there are any weaknesses. And also really deploy the methodology of materiality, okay? What do I mean by that? If you've got, let's say, if you're trading currency over an exchange which is 8 years old, do you want to put $100 million onto it? And the argument is, oh, probably not. You're wanting to look for one of the household names where you can get some confidence around it as well. And out of all of these factors, probably the most significant out of all of the infrastructure is really the weight and quality of the management team that is running the strategy. And I would basically break this down into three areas. The first is the front-end management that's running the strategy and selling the strategy. These people tend to be very visible, and they tend to be very accessible because they'd be approaching you with a strategy in the first place. Okay? But what, again, we spend a lot of time doing is going into the back office and risk management part of the strategy, whereas ultimately where our capital is going to be deployed and safeguarded by third-party people and institutions. But the third bucket that also requires some digging in is what's the governance structure overplaying the strategy itself and the people in the front office. And I think that governance structure goes beyond just are there investment committee structures, are there board meetings, are meetings minuted, and all of the usual stuff. But also, what is the real level of understanding behind the board members or investment committee members of the strategy? Are the board members, investment committee members common with the management team? If so, that can become a conflict of interest very quickly. How much of the board, how much of the investment committee is outside of the management team? Is there real independence? And do they have the sort of background that if their reputation were to be put at risk, they would represent your capital in its best interest? Okay, if we could move on to the next slide. We can then turn on to, once you've decided to invest, you've done your due diligence, you've ascertained that it's not a scam, how do you start to think about putting the conditions around your investment in order to protect it? Well, clearly the first thing you've got to do is have a deep understanding of what the existing conditions are. And what I mean by that is a thorough examination of the offering document that is presented to you with the presentation. If an investment opportunity offshore doesn't have some form of prospectus, PPM, or other similar documents that's more than 30 pages, I wouldn't bother investing in it myself. It's probably not robust enough to warrant attracting your capital. Similarly, when you look at that offering document, if the substance of that offering document is 90% boilerplate risk mitigation clauses and comments about the regulatory environment in various countries, that probably indicates that there is a weak level of governance over the investment opportunity that you're evaluating, and that is a red flag in its own right. That may not be an outright decision to decline the opportunity, but it should be a red flag that drives you towards that negative decision process. We have seen very good strategies with small prospectuses, but it is a good acid test to see whether there's substance. And at the other extreme, we've seen cases where I've actually received a prospectus that is 1,500 pages long, no less, for a very small strategy, which was clearly overkill for the amount of investment that we were looking to deploy onto it. So take a look at that. Then you have to evaluate to what extent can you influence those conditions, what extent you can negotiate those conditions. And issuers and prospectus issuers, particularly if they're in the public domain, really don't like to amend their terms if they can avoid it, particularly if it's for a smaller investor. However, obviously, the way to try and grow your influence is if you are a larger investor in their overall cap table, then you do have that power to start influencing. And typically that will be undertaken and underscored in the side letters that it can sit alongside perfectly legitimately with the original prospectus. Okay? And within that, the conditions that I would strongly recommend people start to look at are all based around the quality of the infrastructure rather than trying to meddle with the underlying strategy itself. Okay? The people who brought the strategy to you are the subject matter experts in that particular field. And I suspect it would be difficult for many of us to outsmart them at the condition stage. However, where you, as we mentioned earlier, where you are highly likely to lose your money is some break, malfunction, or deterioration in the infrastructure supporting that structure, which any of us with some experience can start to evaluate and also look to make some improvements on. And I'll come on a little later to actually include a few tips as to what we will typically put into these conditions in order to make them more robust and more credible. And then finally, the other mantra that we use in this office, and can't always be deployed, but should be the very last measure, is cash is king. What do I mean by that? During our history, we have made losses and we have been defrauded as a company. I think it's good to admit that. There's probably been about half a dozen incidents that we've encountered where we've been victim of that, both in terms of fraud and also misrepresentation. What we typically do is we insist that we only move cash off our own balance sheet and at the moment that it's absolutely necessary to do so. And if there is any way of deploying the strategy on an infrastructure that's under our control, then basically we will go down that route, even if that means losing a strategy. It is so vital in protecting and preserving your capital, it doesn't really bear worth repeating because it is so important. So we've already gone to the extent of building exchanges for ourselves, opening up custody accounts for ourselves, opening cash segregated accounts for us and ourselves, etc., in order to maintain control over the cash, because that's the most vital thing. However, you may come back and ask us the question, as a corporate CFO or as somebody that's a private investor or working for a family office, how can I can't, I don't have the expertise to build a stock exchange or a currency exchange. How do I protect myself better there? And probably the best thing to do that I would recommend in this case is start to go down the SMA account, the segregated managed account, where you actually still are the legal owner of that account, and let the strategy trade over that, but no cash can be withdrawn or put into that account without your consent and agreement. And then you're basically reduced to the risk of an infrastructure failing or a failing of the strategy, but at least your cash is going to be contained and safe. And clearly, there are combinations of institutions that can do that, ranging from security trustees, escrow accounts, your own bank, and other institutions that can manage that for you. So moving on, if I may, to the final slide before we open this up to Q&A. The final process of any investment is, how do I monitor that investment, and how do I put some sort of structure around it to make sure that one day I don't wake up and the investment's gone or it's been impaired badly. And here again, we advocate, sorry, can we move the slide on by one, please? Thank you. Here we advocate very strongly, and we self-impose this on our strategies, is the use of third parties. And these can be people like trustees, accounting firms, subject matter experts, who actually come in to validate and reconfirm performance of the strategy or the strategy itself. Okay. Not only does that add a lot of credibility to the strategy, but it is also critical in attracting new investors to make sure that a well-known, regulated, multinational organization has gone in and reviewed what you're doing and certified that it is legitimate, correct, and accurate. Okay. Second area is always insist on direct access. If your strategy only has a monthly statement or some other form of advising you of how you're doing, we'd strongly recommend you look at that very carefully as a strategy to pursue. In this day and age, it will take you no less, maximum of $50,000 and some coding time to build an investor portal for any firm. And if a firm can't afford or won't do that, that's actually saying something very strong to you as a potential investor. Okay, so look for that direct access, look for that daily direct access as well, and don't rely just on other people's reporting of that. If you do have to rely on reports, make sure those reports are compiled by a third-party specialist, not by the strategy runner themselves. And then finally, as you start to build up this infrastructure and skeleton that tries to protect your capital, please do have a look at the quality of these service providers. Okay, and sometimes there can be some surprises for those. We see a lot of algorithms and artificial intelligence. And initially I wanted to get these audited by the Big Four. That is simply not an audit that they will undertake because of the liability associated. So we have to identify subject matter experts who have had sufficient credibility and knowledge of AI and algorithms in order to go into the strategy to basically undertake a review. They won't call it an audit, but it's like an audit, to basically ascertain, are these guys performing as they are saying that they're performing, and are they making the returns that they're claiming to return? And then that brings us, I think, quite neatly, Pankaj, to the end of the deck and the usual disclaimers, which are also worth a look at, by the way, that you get attached to a lot of these investments. So, Pankaj, I'll hand the microphone back over to you and let you take it up from here, please.
Thank you so much, Nick. I'm sure that it has been really very insightful and useful for the audience to listen to you and Indranil I think that there are a lot of questions already in the queue, but I would like to remind the audience that please feel free to ask whatever questions you have to both Nick and Indranil. And before I take up the question from audience, I had one question of mine actually. So, Nick, you raised a very important point that there is a difference between what is a known unknown and unknown unknowns. So, in an environment like this, because these are the assets which has, I am not comparing the regular equities or debt or any other assets, but I'm saying that this is an asset class where you would have to encounter a lot more of that part. And is there any structured approach you can adopt to address those challenges? So let's say if you are looking at straightforward equity investment or a very structured product which is available, but in this kind of a case, you have a lot more known unknowns and I would say far more unknown unknowns. So is there a structured approach you have, or what do you do to address those kind of risks?
Okay, so let me, Pankaj, answer your question with what not to do. So typically, a lot of people start to look at the combination of techniques here. A lot of people look at back testing, for example. My strong recommendation to anybody is do not look at back testing. It is a self-fulfilling exercise to make you comfortable, okay? The second thing that people often do is say, can I put this onto a paper trading account, this strategy, and then get comfortable with it? Paper trading accounts are similarly, they're not as dangerous, but they are dangerous. Why are they dangerous? The purpose of the paper trading account is typically to entice a new investor onto a platform, an investment platform. And therefore it's preset with the best bill prices, the lowest commissions, the best prices, no slippage on prices, all of these things to basically look as if you're a rock star of an investor. And then when you put real money on, guess what happens, okay? So back testing is one thing. Paper trading, I wouldn't necessarily get involved in. And then you start to look at some of the common ratios that are used to evaluate the volatility and performance of a particular strategy, Sharpe ratios, Saltena ratios, etc. Those start to become useful and predictive. But the most useful ones that I would urge people to focus on is those that try to ascertain the performance of the strategy during periods of high periods of volatility. Okay. Now, one of the issues that we're facing and the industry is facing is the last time that there was a total systemic shock to the financial system was 2008. Most of the strategies we're now seeing have not been through that experience. We have used some artificial intelligence to put those strategies through those types of simulation tests, and that's far better than any back testing or ratio testing. But that is something that if you're going to look at a material investment, it's seriously worth considering as the best way to ascertain it. But you know, you may not like the answer, but there is no real answer, because if you turned around and said the last major blip we had in financial services was the arrival of COVID, and there was going to be a flu-like disease that would put everybody into their homes, and you said that 3 years beforehand, you would have looked at them and thought that they were clinically certifiable, okay? And it's really basically how well prepared for that event, rather than trying to think what that event is from that. But if you've got great infrastructure, if you've got, you've built up control over the cash, you've done your due diligence properly, that's all anybody can ask you to do.
Thank you, Nick. And I completely agree, because that's why they say that investment is as much an art as science. So that's where, like, all those quantitative factors, all those things which you have, but at the end of the day, you have to have some sort of framework which is unique to you, which is original to you, and which you have developed. And after, I would say, a lot of mistakes also in the process, and then you arrive at something which hopefully will work for you. And I completely agree that was a great answer, Nick. Now I'll take up questions from the audience. We have a question from Ahmad Ali. And his question is, what is the benchmark for measuring the performance of a specific asset class, especially for new emerging asset classes, while the impact on current portfolio is directly related to evolving geostrategic relations in the low interest rate environment? So, of course, it might be coming with the context of how the interest rate environment changes, and there is so much of geopolitics which could be relevant for investment decisions. But what is your take on this, Nick?
So investment strategies, basically, I would say somewhere in the region of 95 to 98% high performance investment strategies, this is, thrive during periods of volatility. Okay. There's a very strange world at the moment. We're on the eve of the US election with possibly the risk of a third world war about to start. You have interest rate discoupling between Japan, the EU, and the US and Canada. So markets should be a lot more volatile than they are at the moment. Okay. So in any strategy, there is the volatility breaking point. And that is basically when the volatility gets so extreme that basically it actually snaps the strategy. And that's where you get the capital loss. So what, as a manager or an investor, you need to be thinking about, even if it's a hypothetical level, okay, it doesn't have to be a statistical level, is what is the breaking point on this strategy? What has to happen? So, for example, we've got two strategies running at the moment. One just trades euro dollar, whereas another one trades 23 currency pairs. Now, the breaking point of the latter is considerably higher than the former, because you will always have other currency pairs at play for that one parabolic move in any particular pair. And therefore, the risk profile of that, subject to all things being equal, will be lower. Okay. And therefore, you then have to think about, are the returns that are being generated from that risk profile sufficient in order to warrant my capital being deployed into that particular strategy? Most strategies like a dynamic interest rate environment. Okay, so if we've got further rate cuts ahead, then that should be good for a lot of high performance strategies. Interestingly, today I saw the first range of articles coming out saying that if Trump wins the election, rates may even go back up. So, for us, this is good news. But for the rest of the world, that may not be the best news.
Thank you so much, Nick. There is a question from Dravya Sangvi. How should we avoid taking risks in a scam, or identify the scams from which we can protect ourselves? It might be a generic question, but if there are anything which you want to share and what you've probably been helped with, that's something will be very useful for the audience, I would say.
Look, listen to what your brain and your heart is saying initially. And if there's things that this is too good to be true, this looks artificial, there's a strong chance it is. It may not definitely be. And as soon as you get that slight thinking, feeling, concern, absolutely the strongest piece of advice is go and find somebody you know who is an expert in this area to validate the transaction. So last night, my business partner in Canada, sent me over a whole list of bogus financing documents for project finance in Fiji. And it took me about 30 seconds to say, Jeff, this is a scam. And he's probably saved himself about 20 hours of phone calls and document review as a result of it. But it was a secret division of HSBC in London that was doing development funding for infrastructure in Fiji, for $2.5 billion. I don't think the GDP of Fiji is as large as $2.5 billion in its own right. Never mind the project to finance it as well.
I think that's a great answer. I think it also reminds me of the very interesting takeaways from some of the books which Malcolm Gladwell has written, that your intuition and what you feel about something is as important as the data which is being presented. As you said, like 30 seconds versus 20 hours, and then combining what is physically possible in a small country like Fiji and what is being offered and what is on the table. And at times, like, this is something which is very interesting. Like, just to share a data point with you, Nick, in India, the studies which the regulator SEBI has done, they said that 90% plus traders, which are retail traders, individual traders in derivatives, they make losses. And that has been the data that is consistent for last few years. Means that people are not learning. So at times there is a hope, there is a tendency to probably imagine that you might be able to beat the markets. You might be able to do something which others are not able to do. And that probably is the first sign that you are getting a little greedy about this entire thing. But again, thank you so much, Nick. This was great. There is another question, and this is about the risk management framework, and this is about the risk management strategies you might have. And the question is, if you were to call out a good risk management methodology, what all it would entail and what all it would have its component in?
Yeah, good question. So basically, for me, the best risk management framework that I've seen is something that is in its design is generic enough to be laid across pretty much any investment opportunity. However, within the structure of the risk management framework, has the ability to draw on the expertise, data, and review due diligence process in order to be specific to any asset class or investment fund. And if you've got something that's broad as it's that, we use one where we've got 8 sort of sub-chapters to go through each particular one. They're all generic at the sub-chapter level, but part of that is, have you spoken to an expert in this particular area? Do you have one in the team? Do they have them in the people running the strategy? Do they have them in the risk management team behind the strategy? All of these follow-on questions, which you can then go into help evaluate from that as well. Pretty much in every asset class, somewhere in the world, you will be able to find somebody who's been trading an asset class for at least 30 years that's got the relevant experience to look at this properly.
That's great. Thank you, Nick. Another question is that can you discuss the general ballpark figures in terms of returns you expect for the different strategies you have, and what determines that? Of course, there would be a risk and reward and probabilistic scenario, and you talked about a lot of these things like Sharpe ratio and everything. But in general, what should be the ballpark number you would say that, okay, this qualifies my threshold, and then this is something which is above my threshold, and I would probably evaluate it. Is there any answer to that?
Yeah, so we only start looking at any strategy that starts producing net to the investor capital 20% and above. We won't look at incubating anything until it gets to around about 50% and above. Okay. We generally find that, say, for example, we've got a large cap US equity strategy that we're incubating at the moment. The manager was able to produce returns of about 33%. Through our structuring and allocation of capital and risk management processes, we'll be able to take him up to probably 65–70% type of return. Okay. So that is a strategy that we will invest some time entirely with our own capital to start off with. And then when we've done our full process, which typically takes anything up to 2 years, we'll release it, for third-party capital. We see a lot of strategies producing north of 50%, probably 2 to 3 a week. Okay. The vast majority of those strategies are not investable for a number of reasons. But those will typically come down to issues around there is not enough transparency from the manager to invest in there. There is too much volatility and threat of loss of capital in the strategy to take the risk. And then thirdly, there's a lot of strategies out there where this does sound a little bit strange, but it is a common occurrence, whereby the manager is not able to tell you what they are about to trade ahead of trading it. So, for example, we've got a little bit of money on a strategy we're running that's run by a 72-year-old Indian gentleman, and he's making more than 40% a month, but he can't tell us what he's about to trade, therefore we can't commercialize it. You see what I mean? And so he's very frustrated and we're very frustrated, but it's a lovely story that people are still trading at the age of 72 of some signals that they've spent 20 years preparing themselves.
That's an apt example, like the way, especially post-COVID markets, and I would say last couple of years in Indian markets, except for last few weeks when there has been a little bit of correction, there are a lot of examples where if you offer somebody 20%, they will say that, what's the big deal? I can make 30-40% in the markets very, very quickly, and maybe probably in less than 6 months. So that's definitely, there is a recency bias which comes in. How much money you have made, what are the returns in last few time frame, and that's something which plays a role. But that was an interesting example, Nick. Thank you for sharing it. Another question which is there, that in this entire thing, there is a very important role for regulators. And what do you think that, like, what should be their role? Because sometimes there could be over regulations, sometimes there could be under regulation, and nobody knows. It's only after the event is done and it's over, you would probably realize whether there was an over regulation or under regulation. And what could be the situation here in terms of how do you see the regulation evolving, and what should be the role of regulators to ensure that there is enough risk capital which is available, and also it is getting rewarded adequately in a way which is important for that particular investment to come in?
So, that's an excellent and difficult question, but let me have a go at answering it. So first of all, regulators are obviously a good thing. The main criticism we would have investing into these types of strategies is that a regulator is only really concerned about their domestic market or their domestic consumers. And any regulator also is predominantly concerned about their retail investors. The vast majority of these funds, be it hedge funds, private equity, are generally only available to what's called qualified, accredited, or professional investors or institutional investors. So in doing so, you probably lose at least half of your regulatory cover by participating in that. That is a risk that you just have to absorb, however uncomfortable it is with that. So if you ask me what was the single most important thing the regulatory environment or community could do, is to work much better together. Okay, I'll give you a case. We were actually defrauded by a Canadian company about 4 years ago for $1 million. And part of the fraud was they purported to be a Canadian regulated entity. Okay. And when the tide came out and we realized what had happened, is the entity was actually regulated by FINRA and the SEC in the United States, and had used the North Atlantic Free Trade Agreement to get immediate regulation in Canada. And so when we went to complain to the Canadian regulators and authorities, once they realized that the money had been taken into the US, zero interest in supporting them. Once they realized that the actual capital was not from Canadian retail investors, this is not slamming the Canadians, you'll get the same response from every regulator. As long as their own retail investors are protected, as long as their own environment is protected, they're covered. And seriously, the next big challenge for regulators is to go cross-border. Money moves so quickly, we all know that. And unless you can get some sort of framework to cooperate across border, it's going to be chasing the dog's tail.
Thanks, Nick. I think this was very, very interesting perspective, and I don't think it could have come from someone who has not seen across cycles, across different geographies, and across different regions, the markets. And that's something which was the added advantage probably you bring to the table. Thank you, Nick, for sharing your perspective on this. There is a question from Vaibhav Raj Sindwani, and he's asking, how would you hedge against the specific risk linked in each company or an investment you are exposed to, and while maintaining that you are there to take the upside from the growth potential available, or from the interesting upside which could come in from that particular investment. Is there any specific thing which you want to share on that?
Yeah, it's an interesting question. So if you're going to hedge or protect your capital, do it in the structure, don't do it in the strategy. And I'll give you our sort of argument behind that. In the structure, maybe, for example, we put strategies into capital protected notes issued by global banks. Okay, that helps investors protect their capital. But if you start to put your hedging into your strategy, okay, or sorry, another one is a stop loss on a foreign currency position is part of the structure. But if you start to hedge in your strategy, you'll do two things. First of all, you'll bring down the performance of the strategy. You may say that's worth it, but you know, that's a personal decision. But more often than not, you will actually find that you put the strategy into a status where it can't go up and it can't go down, and your balance sheet is locked. And with most financial assets that you invest in, you've got a cost of carry on an ongoing basis, and your capital is just getting eroded by that cost of carry. And there's nothing you can do. You're locked. By definition, hedges are locked. Okay, and therefore, if you're locked, you're not suddenly going to get your take profit level or your exit point that you dreamed of by locking yourself in.
Thank you, Nick. I think there are a lot of questions on risk. I probably, in the interest of time, we'll just take the last one. And this is a question about the overall risk on your book. So, like, when you look at a strategy, it might lead to something very, very different inference and outcome if the portfolio or the overall books are looking very, very different. And are there any overall broader risk matrices you have that you maintain, or what is that you do to ensure that while in a particular strategy, the risk might be at acceptable level, but in your overall books, it might still lead to an outcome which is not up to the desired level, or it's higher than that. So is there something you want to share on that, Nick?
Yeah, very, very simple answer to this package. It's called skin in the game. So most of our strategies, we put 80%, up to 80% of our own capital alongside the investor capital. That tells the investor very strongly we believe in that strategy. Okay, and if there is a loss, we're the first money lost, and you can't get any better mitigant, structuring due diligence than putting money where the mouth is.
I think it's amazing. It's like somebody who owns a restaurant and does not eat food there.
Correct.
You don't invest with that. That's amazing. Thank you so much, Nick. I would say that it was a fascinating conversation, both with yourself and Indranil. Thank you so much for joining. And thank you so much for sharing your experience and insights with us today and with the audience.